When it comes to diversification in your portfolio, international stocks could be an option for you. So in today's video, we're going to be looking at some of the ETFs on the international side, which overall, a lot of people left comments on the YouTube videos saying that we should look at more international and not so many US holdings. So I wanted to break this down. Now, this is an article on optimizedportfolio.com on why international stocks and why international ETFs. They do a really good breakdown of the top 5 ETFs to go ahead and buy. So when you look at the lowering portfolio volatility and the risk that we have based in the US markets, that is the biggest reason why international ETFs should be on your radar. So looking at the global weight, the US makes up roughly 50% of the global stock market. So you have to think in the US, we are only 50% of the global stock market. The top target data funds now allocate 30% of equity positions to X or non-US stocks. Moreover, considering the historical performance of the emerging market sector, excluding international stocks, mean that you'll miss out on really good opportunities, and also considering that most of the largest automotive, tech, communication companies, and electronic companies are not US based. That is right. Even though they are names that we are familiar with, they are not US based. Now, looking at a significant amount of time frame, so looking starting in 1970, there has been a multitude of years where the global market or the outside of the US market has outperformed the United States market, and some of these for a considerable amount of time. And again, this is something that was noted from the comments in the YouTube section. When you look at a portfolio, most people are saying 80% US based, 20% international based, because of the risk adjusted return that you can see versus just having 100% of the US based portfolio. When you look at the international stocks, they have outperformed 86 to 88, 93, 99, 2002 to 2007, 5 full years. International outperformed the United States, 2012, 2017, and of course, the really rough year we had in 2022, which was very down for the US market. But international wise, they were doing incredibly well. Now, it's very important to know that, of course, you're not going to know the in and outs of all of the global markets unless you're doing a crazy amount of research. But when you're looking at the risk mitigation factor, if there is anything that happens essentially with the US markets, you'll still have a portion of the portfolio in the international side. Now, on this, for US investors, holding international assets is a way to not only diversify currency risk, to hedge against a weaker US dollar, which we've seen gradually declining for decades. International stocks tend to outperform US stocks when the US dollar declines. So again, you're kind of hedging your bets if you're holding, 80% in those US ETFs like we talk about, and holding that other 20% in these international ETFs, which again, I want to break down, and I'm going to actually be adding some of these to my portfolio. So looking at the 5 best international ETFs, we start with number 1, which is the Vanguard Total International Stock ETF. This is the VXXUS. Now I'm going to go ahead and put those on the screen because I know, again, comments that I'm getting, feedback that I'm getting, wanting to make sure that you get this. Now this offers some of the cheapest exposure to the assets outside of the United States. Vanguard Total International Stock ETF is the most popular broad international stock ETF. For a good reason. It has a very low expense ratio of 0.07, provides affordable access to the total international stock market, which of course the ETF seeks to track the FTSE Global All Cap US Index, has $420 billion in assets. So Vanguard funds, we've talked about them a lot, and this is a massive fund, guys. You're talking almost $420 billion under asset management in this fund, meaning they're coming up and getting close to $500 billion in this fund itself. Next one we look at is the VEU, which is the Vanguard FTSE All World XUS ETF. So I know the names can be incredibly complex. So very similar to the one that we just looked at. This fund seeks to track the FTSE All World Index, has about the same ratio. Now the big thing with this one is they both have a lot of liquidity when it comes to international ETFs. Performance has been almost identical. Now, the big difference between these two is if you're looking at international, the VXUS holds about 7,500 foreign companies compared to the VEU that holds roughly 3,500. So when we look at the portfolio and we look at this 20% that we're putting into these ETFs, we are looking to really diversify the portfolio. So having it into 7,500 holdings versus the 3,500 is the reason why a lot of people say to invest in that VXUS, the Vanguard Total International Stock, versus the VEU. But overall, the return has been very, very similar. Then we look at the iShares Core MSCI Total International Stock Fund. Very similar. The ticker symbol for this is IXUS. So this is an international stock fund, broadly diversified international stocks, seeks to fund or track the MSCUI, which again, if you're not familiar with the terminology, guys, quick Google search is going to show you. This is a very fine replacement if you're not looking for either of the Vanguard funds, but above to avoid a wash sale across multiple accounts. If you're looking for tax harvesting, this is one that can actually fit that bill. Has the exact same expense ratio, the 0.07. So again, it's very similar to two that we have already seen. Now, looking at number 4, it is the VEA, which is the Vanguard FTSE Developing Markets. Now, this is one, again, that we kind of heard about. This is looking in developing markets outside of the United States only. So again, this is not in very well-established place. This is looking at the developing. Now, this does hold 4,000 holdings with a 0.05 expense ratio, covering 120 billion in assets. Now, this is, again, something that is in developing markets. It is not in the countries that are already developed, that have their own system, everything of that. So it seeks a little bit higher of a return with the developing markets. And then one that we talked about, which is the final one on our list to round out the top 5, is the VFO, which is the Vanguard FTSE Emerging Markets. So definitely different than the developing markets. And we're going to go over exactly why. So looking at the emerging markets, again, this is a little bit different than just those developing, because this also includes China in this index. It also contains developing countries. They mentioned Taiwan, India, Brazil, and a couple other ones in here. Now, the VWO, it says, might be the most important fund on this list. Developing markets are highly correlated with the US market, doesn't offer the diversification. So again, this might be the reason why you want to look in those emerging markets, because with the diversification and looking at the developing markets, they are very similar historically to the US markets. Emerging markets offer a far superior diversification and also conveniently pay a significant risk premium historically. Now, they have beaten out US stocks historically when the dollar or the value of the dollar is decreasing. This has been really taking out and beating the US market, which again, when you were looking at like 2022, you would have seen a lot bigger yield in the emerging markets Vanguard ETF than you would have seen by holding any of the US ETFs that we kind of talk about. Now, emerging markets comprise about 11% of the global stock market. These are the emerging markets. Note that the emerging markets as a whole are very highly volatile in comparison to developing markets. And again, this was some of finding this article, doing the research, checking out some of these ETFs took a considerable amount of time, but I wanted to understand them because I know all of my portfolio currently is all housed in the US. And I think the diversification, as we continue to get more money in the portfolio, really does make sense. Now, looking at this again, looking at the VXUS, which is the total US stock market, is 3-to-1 ratio of developing markets to emerging markets, which is the reason why the VXUS is 75% VEA, 25% VWO. So you're getting a really, really good blend in there when you look at the developing markets and the emerging markets with the 3-to-1 ratio, which is pretty much built with the VXUS, which is exactly what I'm going to be investing in. Just as a recap, guys, the VXUS is the Vanguard Total International Stock ETF. This, of course, is some of the cheapest exposure outside of the United States, most popular brand of international stock ETF. For a good reason. The performance in this has done incredibly well, and there's actually been several years where this has outperformed the US markets just based on the international capacity. And we also want some exposure to developing markets and to those emerging markets. So guys, if you're holding these international ETFs, definitely let me know in the comments. We were going through looking at a lot of these ticker symbols. And again, we're going to go through, edit this, show them up on the board. That way you can check them out. But that is going to do it for today's video, and I'll catch you in the next one.